We'll talk about the chapter 3, which is investment banking. Today's agenda is the first one is transfer of funds from savers to businesses, the role of investment banks, price and volatility of IPOs, shelf illustrations, regulations, and Sarbanes-Oxley Act of 2002, and wrap up. The review of the last session, chapter 2, is the how can we convert between APR and EAR. Is the interest rate per compounded period is we just calculate the APR divided by M. This is compounded period. M is the number of compounding periods per year. So 1 plus effective annual rate is equal to 1 plus effective annual rate, effective percentage rate over M divided by M. So M is the number of compounding periods per year. So quick practice, last time we have compound monthly, now we have quarterly, and now credit card charge 27% APR. What is the effective annual rate? Solution is as it specifies quarterly and 3 months. We have 4 periods per year, and the M is 4. The calculation is same. Instead of 12, we divide by 4. So AER plus 1 is equal to 1 plus APR divided by M. So APR is 27%, M is 4, We have APR rate 27%. So we just calculate 27% divided by 4 plus 1 over 4 equals effective annual rate plus 1, and we solve this equation and find 29%, 86. Just a quick review of chapter 2 as a part of chapter 2. And we have transfer of funds from savers to businesses. The chart named the players in diamond. One purpose of financial markets is to facilitate the transfer of funds from individuals and firms and governments with funds to invest to those individuals that need funds. And one method is, as you remember, indirect transfer through a financial intermediary. Indirect. And the other method is direct investment. Direct investment in the firms by the general public. The transfer occurs when you start your own businesses and invest your savings in the operation, but the direct transfer is not limited to investing in your own business. Firms also raise funds by selling securities directly to the general public. This is direct, and this way is indirect. And as a financial markets, you remember the investment banks, brokerage firms, hedge funds, angel investors, and venture capital investors are the financial market participants. And direct transfer can be achieved by IPO, initial public offerings, or secondary market operations, like selling stock trades in exchange. And the role of investment banks is, while companies could sell securities directly to you, and some do sell modest amounts of securities through programs such as dividend reinvestment plans. The majority of these sales are executed through investment bankers. The definition of investment bankers is this is the middleman who brings together investors and firms and governments issuing new securities. IPO is the first sale of common stock to the general public. And underwriting, the definition of underwriting is the purchase of an issue of new securities for subsequent sale by investment bankers, the guaranteeing of the sale of new issue of securities. These are the companies, financial institutions such as Morgan Stanley, Merrill Lynch, There are underwriters, and they buy, and the investment banker buys the stocks to sell the market. And the best offers agreement. Um, Regarding best offers agreement, the two parties can agree to sell the securities through an agreement, and investment bankers do not underwrite the sale and do not guarantee the specified amount of money will be raised. Instead, the investment bankers agree to make their best efforts to sell the securities, but the risk of the sale is borne by the issuing firm. If the securities do not sell, the firm does not receive the funds, while most sales of the new securities are by underwriting. Small issues of risky securities are often best effort sales. Originating house is an investment banker who makes an agreement to sell a new issue and forms a syndicate to sell the securities. So the originating house is just an entity, financial institution. For example, Morgan Stanley. Morgan Stanley can form a syndicate and get together different financial institutions to form a syndicate. And preliminary prospectus, other name is red herring, is the prospectus initial document detailing the financial condition of a firm that must be filed with the SEC to register a new issue of securities. IPO is so exciting because, for example, Lilo raised 25 billion in his debut, making it the biggest US listed IPO in history in 2014. It's just he was a teacher, and he has several failed ventures, and by taking good steps and wise steps, he just built a empire. And pricing of a new issue. Because most sales of a new securities are underwritings, the pricing of securities is crucial. If the initial offer price is too high, the syndicate will be unable to sell the securities. When this occurs, the investment bankers have two choices. First, to maintain the offer price and to hold the securities in inventory until they are sold. Second, to let the market find a lower price level that will induce investors to purchase the securities. Then neither choice benefits the investment bankers. And marketing new securities is one of terms of the sale have been agreed upon. The managing house may issue a preliminary prospectus. This prospectus must be registered with the Securities Exchange Commission, and by using their prospectus, they go to roadshows for investors, and they're explaining verbally what the company offering for investors, and they just market the company in the roadshows. And this is the example of one of the prospectus for Facebook IPO. As you see, they registered 70 million shares, Class A common stock, and they're saying Class A common stocks in the Nasdaq Global Select Market was 55.57 per share, and the date for the registration, and these are the syndicate members for the IPO. And the volatility of the market for initial public offerings. The new issue market, especially for the initial public offerings of a common stock or initial public or IPO, can be extremely volatile. Periods have occurred when the investing public seemed willing to purchase virtually any securities that was being sold. For example, the dot-com period during the 1990s. There have also been periods during which new companies were simply unable to raise money, and large companies did so only under onerous terms. As you see, Uber and Lyft, uh, those are the recent IPOs, and their IPO performance um, is not good, and they are they lose the stock price just decline just 4 or 5 months since they went IPO, and the performance is here for Lyft and here for the Uber. So another example is Snap Incorporation. After the IPO, the stock market just fell down. The performance of this stock is just losing its value, and so prices can rise or decline dramatically after the IPO. Few IPOs are really successful. Many IPO firms initially do well but fall on hard times, such as Snap Incorporation. And hot IPO markets, there's a definition. Hot IPO markets, when the new issue market is hot, it is not unusual for the prices to rise dramatically. For example, Twitter went public, priced at $26. The stock opened Twitter. The price $26 registered in the registered for the value of $26. But the stock opened in the IPO day $45.10. It's a huge jump, and reach $50 during the day. So it's this kind of movement for the first day of IPO called hot markets, hot IPO markets. And long-term returns do not beat market returns in average. Is another example, Twitter and Facebook. After the IPO, the stock price rises, and almost the day of 22, more than 50%. And for the Facebook, after the IPO day, day one, barely lose money, barely lose value compared to the IPO day. As you see, there's another example. Twitter flies high in IPO. This is the IPO day. During the IPO day, it reached $44.90. And another chart, a graph for the volatility of markets during IPO. It's just country by country. For instance, Canada between 1971 and 2006, the first day volatility is less than 20%, but if you go to China, the IPO market first day volatility is more than 100%. So emerging markets are crazier about IPO. This is the number of offerings per year in US, and as you see, late 90s, it's the peak value reached the late 90s and then declined sharply. So another topic we should cover is the shelf registration. The previous discussion was cast in terms of firms initially selling their stocks to the general public, and firms that have previously issued securities and are currently public also raise funds by selling new securities. If the sales are to the general public, the same basic procedures applies. The new securities must be registered with and approved by the SEC before they may be sold to the public, and the firm often uses the services of an investment banker to facilitate the sale. Many publicly held firms, such as Twitter, Facebook, Amazon, construct a prospectus describing a proposed issue of new securities and file it with the SEC. The document is called a shelf registration. After the shelf registration has been accepted, the firm may sell the securities whenever the need for funds arises. So kind of they just registered stocks they want to sell in the future, and let's say they registered 100 million shares in shelf, but they want to sell only half of them, 50 million of them. They can sell it one point of time, and they can sell half of them in another point of time. It gives flexibility for the companies and reduce their costs. And yeah, and the securities sold as funds are needed. Yeah. So seasoned equity offerings is firms returns to equity markets and offer new shares for sale. So this is the secondary offer. Season means the secondary equity offerings. After the IPO, by registering, by having shelf registration, companies can have seasoned equity offerings. In other words, second equity offerings. They can sell their shares by using shelf registration. Private placement is non-public sale of securities to a financial institution. In addition to public sales of securities, firms may raise funds through private placement, which are non-public sales of securities. Such sales are made to venture capital firms or mutual funds that specialize in emerging firms. Small firms are often unable to raise capital through traditional sources. The size of the issue may be too small, or the firm perceived is too risky for an underwriting through an investment banker. So venture capitalists does fill a void by acquiring securities issued by small firms with exceptional growth potential. So such sales are made to venture capitalists, in short, or mutual funds that specialize in emerging firms. So this is direct sale of securities, reducing selling cost. Feature can be tailor-made for both parties. Another definition is pipe. Pipe is private investment in public equity, often called a pipe deal, involves the selling of publicly traded common shares or some form of preferred stock or convertible security to private investors. It's an allocation of shares in a public company, not through a public offering in a stock exchange. So public companies, the shares of public companies can be sold through pipes to venture capital. So public company shares can be sold venture capital investors or private equity firms through pipe deals. Regulations and SOX. For the regulation, full disclosure laws, depending on importance of information. So federal securities laws requiring the timely disclosure of information that may affect the value of the firm's securities. For instance, 10K reports or 10Q reports. 10K reports require annual report filed with the SEC by public health companies. This is annual report. 10Qs are the quarterly reports. These are required by the required for publicly traded companies. Also, insiders must file their transactions in the for the company they are working. Okay. And SEC is the Securities Exchange Commission, enforces the federal security laws, the Security Act of 1933 and Security Exchange Act of 1934, information disclosure and issues. Companies required to disclose information, and any information that may materially affect the value of securities needs to be disclosed. And the SEC can suspend tradings in stock exchanges, such as New York Stock Exchange. And another entity is Securities Investor Protection Corporation, which insures accounts against failures by brokerage firms. Coverage limit is 500 grand per customer. So, Sarbanes-Oxley Act of 2002 created in response to accounting frauds and securities analysts touting of stocks. The problem was the independence of auditors. So, the creation of it after the Sarbanes-Oxley regulation creates a public company accounting oversight board, and CEO and CFO certifying financial statements, and senior management should disclose their trading activities of the firm stocks. And after Sarbanes-Oxley Act, the disclosure requirements are increased, and firewall between investment bankers and securities analysts is dissolved. So the timeline of Sarbanes-Oxley regulation is in 2000. There was the dot-com bubble bursts, and the Enron, WorldCom, and Tyco corporations faced fraud charges. And in 2002, Congress passed the Sarbanes-Oxley Act for financial oversight. And now we have in 2019, all IT departments must ensure compliance for financial files and records. What is the basics of the Sarbanes-Oxley compliance? Keep data secure and free of tampering, and track attempt security breaches and resolutions. Keep event logs for independent auditing, and prove compliance for past and 90 days. What was the Enron scandal? The company based in Houston, and shareholders lost $74 billion. Thousands of employees and investors lost their retirement accounts, and many employees lost their jobs. What was the main players? The main players were the two CEO, and they kept huge debts of the balance sheet. So they only show in the balance sheet liabilities. They show all the assets, but they hide debts from the balance sheet. So that makes the company seems to be more profitable, or more financially strength. And how they got caught? Turning internal whistleblower. One of the whistleblower just claimed the scandal. And the fun fact is, the Fortune magazine named Enron America's most innovative company for 6 years in a row prior to the scandal. So they successfully hide their fraud for many years. Uh, so for wrap up, we in this session we look at the role of investment banks, the underwriting definition, IPO underpricing, information disclosure, and APR and EAR review. Please read your notes, PowerPoint slides, chapter 1 and 2 and 3, and be ready for the quiz 1. And please complete mind tab exercises, quizzes, video reviews, and PowerPoint and the flashcards. Thank you for your attention.